Welcome. If you're watching this, you've likely noticed something troubling in the market. Prices have reached a psychological threshold that feels both arbitrary and inevitable at the same time. That threshold is $100. Here's what you need to understand immediately. Round numbers aren't random. They're strategic. They're psychological weapons used by institutional players who understand human behavior better than most investors understand themselves. This video exists for one purpose: to ensure you don't become another casualty of a carefully orchestrated shakeout. A shakeout designed to separate informed, disciplined investors from emotional, reactive ones. What you're experiencing right now isn't coincidence. It's market structure, it's psychology, and it's been deployed thousands of times across every major asset class in financial history. Before we go further, let me be direct. This is not investment advice. I'm not your financial advisor. What follows is educational analysis based on documented market patterns, investor psychology, and historical precedent. Your decisions are yours alone. Your risk tolerance is unique, your financial situation is personal, but your education should be comprehensive. That's what we're here to do today. Let's establish the framework immediately. Markets don't move randomly. They move in patterns driven by predictable human emotions and institutional strategy. The $100 price point represents something specific in market psychology. It's what traders call a round number bias, or psychological resistance level. Human beings are wired to think in round numbers: 10, 50, 100, 1,000. These aren't just convenient figures. They're mental anchors that shape decision-making at scale. When an asset approaches these levels, something predictable happens. Retail investors begin making emotional calculations. If I just wait until it hits 100, I'll sell. Or conversely, I'll wait until it drops to 100 before I buy. This creates concentrated zones of buying and selling pressure at completely arbitrary price levels. Arbitrary, yet powerful. Now here's where it gets strategic. Institutional players know this. Hedge funds know this. Market makers know this. They've studied retail behavior for decades. They understand that round numbers create vulnerability, emotional vulnerability that can be exploited through coordinated pressure at exactly these levels. This isn't conspiracy. It's documented market mechanics. It's the same principle that's played out at every major psychological level throughout market history. Let me explain exactly how this works and why understanding this mechanism is worth more than any single trade you'll make this year. A shakeout is a deliberate period of volatility designed to trigger emotional selling from weak hands before a sustained move higher, or in reverse, to trigger emotional buying before a sustained move lower. The mechanics are straightforward. Large players with significant capital create downward pressure approaching a psychological level. They use this pressure to test conviction. Retail investors watching their portfolios see the number approaching 100. Maybe it touches 98, then 95, then back to 99. Each oscillation creates stress. Each fake-out creates doubt. Each reversal creates the feeling that this time might be different. The psychological wear is intentional. It's designed to make you question your original thesis, to make patience feel like stubbornness, to make discipline feel like denial. This is when the majority sell, not because the fundamentals changed, not because new information emerged, but because the emotional cost of uncertainty exceeded their threshold for discomfort. Here's the critical insight. The very moment maximum capitulation occurs is precisely when institutional accumulation accelerates. They're not buying at the top. They're buying when emotional sellers are handing over assets at artificially suppressed prices, created by coordinated pressure and psychological exhaustion. This pattern has repeated across gold markets, equity markets, commodity markets, and every emerging asset class that's ever existed. The $100 level is being used right now in exactly this way, as a psychological weapon against your conviction. History provides us with perfect case studies. Let's examine three that directly parallel what's happening now. Bitcoin in 2017 faced a major psychological barrier at $10,000. When it first approached this level, volatility exploded. The media amplified the significance. Retail investors became fixated on the round number. What happened? Multiple false breakouts, sharp pullbacks that shook out early holders, then finally breakthrough to much higher levels, but only after the weak hands had been systematically removed. The investors who sold at 9,000, convinced that 10,000 was the top, watched in frustration as prices eventually climbed much higher. Their emotional reaction to a psychological level cost them significant gains. Gold in 2011 provides another example. When gold approached $2,000 per ounce, similar dynamics emerged: round number fixation, media amplification, emotional volatility. Many retail investors sold just before the level was reached, fearing a reversal. Others sold immediately after it broke through, taking profits at the milestone. Both groups exited before understanding whether the move was sustainable. Technology stocks in the late 1990s showed this pattern repeatedly. When companies approached $100 share prices, volatility increased. Stock splits were timed around these levels specifically because management understood the psychological impact. The pattern is universal. Round numbers create emotional decision points. Emotional decision points create exploitable volatility. Exploitable volatility benefits those with patience and understanding. Understanding where we are in the broader market cycle is essential context. Without this perspective, short-term price action appears random. With it, everything makes sense. Markets move in 4 distinct phases: accumulation, markup, distribution, markdown. Each phase has characteristic volatility patterns and psychological dynamics. Accumulation occurs when informed investors build positions while sentiment is negative. This is when assets are cheap, pessimism is high, and most retail participants are absent. Markup is the phase where prices rise consistently. Early skepticism gives way to growing interest. Media coverage increases. New investors enter with growing confidence. Distribution happens when informed investors begin exiting positions to the wave of late arriving retail buyers. Volatility increases. The emotional tone shifts from confidence to anxiety. Markdown is the painful phase where prices decline and retail investors experience losses. This is when conviction is truly tested, when most people sell. Now here's the essential question. Where does the $100 shakeout fit in this cycle? If fundamentals remain strong, if adoption continues, if institutional interest persists, then what appears to be distribution is actually late-stage markup volatility, a final shakeout before continuation. This is the hardest pattern to navigate because it feels like the end when it's actually a transition. The emotional experience is identical to genuine distribution. Only the underlying fundamentals tell the true story. Your job as an investor is to separate price action from fundamental reality. To understand that while prices fluctuate based on psychology, value is determined by utility, adoption, scarcity, and demand. The $100 level creates maximum psychological pressure precisely because it's where these two forces collide most violently. Let's talk directly about what's happening in your mind right now, because understanding your own psychology is more valuable than any technical analysis. If you're holding an asset approaching $100, you're likely experiencing one of several emotional states. Let me describe them precisely. First is premature satisfaction, the voice saying, "I've done well enough. 100 is a nice round number. Time to take profits." This isn't analysis. It's emotional anchoring to an arbitrary figure. Second is fear of reversal, the anxiety that everyone will sell at 100, causing a crash, and I'll lose everything I've gained. This fear is often self-fulfilling at scale. Third is regret anticipation, the scenario planning, where you imagine the asset dropping after 100 and you beating yourself up for not selling. This imagined future pain drives present-day decisions. Fourth is exhaustion. If you've held through significant volatility, the psychological cost accumulates. The $100 level offers a convenient excuse to end the emotional stress. These aren't signs of weakness. They're universal human responses to uncertainty and perceived risk. Every investor experiences them. The difference is what you do with these feelings. If you're considering entering a position, you face different psychological traps. The fear of missing out if price breaks above 100. The hope of getting a discount if it drops below. Both of these perspectives frame decisions around the psychological level rather than fundamental value. This is exactly the mistake that creates shakeout opportunities. Here's what experienced investors understand. Psychological discomfort is often the price of significant returns. Not always, but often. When holding an asset feels hardest, when doubt is highest, when the emotional temptation to sell is strongest, you're often closest to the inflection point where patience is rewarded. This doesn't mean never sell. It means never sell purely because of psychological pressure around an arbitrary price level. We cannot discuss price dynamics without acknowledging the broader economic environment, because nothing happens in isolation. Current monetary policy remains the dominant force shaping all asset prices. Interest rates, liquidity conditions, and central bank positioning create the tide that lifts or lowers all boats. When liquidity is abundant, assets across all risk categories tend to appreciate. When liquidity contracts, everything comes under pressure, regardless of individual merit. Understanding this context helps you separate genuine value signals from macro-driven noise. It helps you recognize when price action reflects your specific asset's fundamentals versus broader market forces. Inflation dynamics matter critically. If the currency in which you're measuring value is losing purchasing power, then nominal price gains may not represent real wealth creation. A $100 price in a depreciating currency environment means something different than $100 in a stable or appreciating environment. Geopolitical instability creates additional pressure. Uncertainty drives volatility. Volatility creates emotional decision-making. Emotional decision-making creates opportunities for those with steadier nerves. Regulatory developments can't be ignored, especially for newer asset classes. Regulatory clarity often removes uncertainty premium. Regulatory threat introduces it. The point is this: the $100 level exists within a complex web of macroeconomic forces. Some support higher valuations. Some argue for caution. Your job is to weigh these forces honestly, not to cherry-pick information that supports what you want to believe, but to form a balanced assessment of genuine risk and opportunity. This assessment, not the psychological significance of a round number, should drive your decisions. If you currently hold positions approaching or at the $100 level, you need a clear strategic framework. Not hope, not fear, strategy. First, revisit your original thesis. Why did you acquire this asset? What were the fundamental drivers that justified the allocation? Have those drivers strengthened or weakened? If the fundamentals have deteriorated, if your original thesis is compromised, then reassessing your position is rational regardless of price level. But if the fundamentals remain intact or have improved, then priced volatility around a psychological level is noise. Painful noise, but noise nonetheless. Second, review your position sizing. If your allocation has grown to represent an uncomfortable percentage of your portfolio, rebalancing for risk management is prudent. This is different from selling because of price level anxiety. This is portfolio hygiene, maintaining appropriate diversification regardless of conviction. Third, establish clear criteria for exit decisions in advance. Not price targets based on round numbers, but condition-based triggers. For example, I will reduce my position if adoption metrics decline for 3 consecutive quarters. Or I will reassess if regulatory framework becomes explicitly hostile. These criteria separate emotion from decision-making. They provide a framework that's immune to psychological shakeouts. Fourth, consider tax implications and time horizons. In many jurisdictions, short-term gains are taxed significantly higher than long-term holdings. Selling based on short-term price action may be tax inefficient. Fifth, and perhaps most important, maintain dry powder. If you believe in the long-term thesis, having capital available to add on artificial dips is strategic, not speculative. This doesn't mean catching falling knives. It means having predetermined price levels where additional allocation makes sense based on value, not emotion. Here's the discipline that separates successful investors from the majority. Successful investors get comfortable being uncomfortable. They tolerate psychological stress as a cost of asymmetric returns. They don't ignore risk. They manage it systematically. But they don't confuse psychological discomfort with actual risk. If your thesis is sound, if your position sizing is appropriate, if your time horizon is sufficient, then the $100 shakeout is a test of conviction, not a signal to exit. If you're considering entering a position, the $100 level creates both opportunity and danger. Let's address both directly. The opportunity is straightforward. If institutional players are using the psychological level to create artificial selling pressure, and you have conviction in the underlying fundamentals, you're being handed a strategic entry point. This is how informed investors accumulate when others are capitulating to emotion, not by trying to time the absolute bottom, but by recognizing when price action disconnects from fundamental value. The danger is equally clear. You could be catching a falling knife. What appears to be a shakeout could be the beginning of genuine distribution. The pattern looks similar. The outcome is very different. How do you distinguish between them? By doing the work that most investors skip. Research the fundamental drivers. Understand what creates genuine value in this asset class. Assess adoption trends. Evaluate competitive dynamics. Examine regulatory trajectory. If fundamentals are strong and improving, price weakness is likely temporary and exploitable. If fundamentals are weakening, price weakness may be the market correctly reassessing value. Don't rely on social media sentiment. Don't base decisions on what other people are doing. The crowd is usually wrong at inflection points because the crowd responds to emotion, not analysis. Consider your entry strategy carefully. Dollar cost averaging around psychological levels often outperforms trying to time a single perfect entry. It removes the pressure of being exactly right. For example, if you plan to allocate $10,000, consider entering with $3,000 now, $3,000 if price drops 10%, and $4,000 if it drops 20%. This approach ensures participation while managing the risk of mistiming. It turns volatility into an advantage rather than a source of stress. Assess your time horizon honestly. If you need this capital within months, you shouldn't be investing in volatile assets regardless of price level. Short-term price action is effectively random noise. If your time horizon is measured in years, then the difference between entering at 95 versus 105 is statistically insignificant compared to long-term trajectory. This is perhaps the most important point for new investors. The $100 shakeout only matters if you're thinking short-term. If you're thinking in decades, entry price precision is overrated. What matters more is position sizing, risk management, and psychological preparation for volatility. These factors will determine your success far more than whether you entered at the perfect price. Now, let's discuss specific behavioral mistakes that destroy wealth during shakeouts. These aren't theoretical. They're documented patterns that repeat with every market cycle. Mistake 1, selling on isolated price action without fundamental change. If your thesis hasn't changed, your position shouldn't change based purely on price volatility. Price is information, but it's not the only information. Sometimes, price temporarily diverges from value. That divergence creates opportunity for the disciplined and pain for the reactive. Mistake 2, over-leveraging positions based on conviction. Leverage magnifies both gains and losses, but more importantly, it magnifies emotional pressure. When positions are leveraged, normal volatility becomes existentially threatening. This forces premature exits precisely when patience would be rewarded. Never leverage to a point where volatility can force your hand. Mistake 3, checking prices obsessively. Constant price monitoring doesn't improve outcomes. It increases emotional engagement with short-term noise. If your investment thesis is measured in years, checking prices daily or hourly is counterproductive. It trains your brain to react to meaningless fluctuations. Mistake 4, changing strategy based on social media sentiment. Platforms amplify both euphoria and panic. Neither emotional extreme is a reliable indicator of rational action. When everyone is panicking about the $100 level, that panic is priced in. When everyone is euphoric, that euphoria is also priced in. Contrarian thinking often outperforms consensus. Mistake 5, failing to document decisions. Write down why you bought. Write down under what conditions you'll sell. Review these documents when emotion is high. Your calm, rational self is smarter than your stressed, reactive self. Give your rational self a voice when fear or greed is loudest. Mistake 6, treating investing like gambling. Gambling seeks entertainment and emotional stimulation. Investing seeks wealth accumulation through calculated risk. If the volatility around $100 feels exciting or entertaining, you're gambling, not investing. Real investing is often boring because discipline is boring. Mistake 7, ignoring tax efficiency. Selling profitable positions triggers tax events. In some cases, the tax cost of selling negates a significant portion of gains. Understand the tax implications before making emotional decisions. Sometimes holding isn't just strategically sound, it's also tax efficient. Mistake 8, having no plan for multiple scenarios. Hope is not a strategy. I'll figure it out when it happens is not preparation. Before volatility strikes, decide what you'll do if price drops 20%. Decide what you'll do if it rises 20%. Having predetermined responses removes emotional decision-making. Mistake 9, confusing price momentum with fundamental value. Just because something is going up doesn't mean it's valuable. Just because something is going down doesn't mean it's worthless. The $100 shakeout exists precisely because people confuse temporary price action with permanent value change. Mistake 10, failing to maintain perspective. Zoom out. Look at the multi-year chart. Look at the fundamental trajectory. 1 week of volatility means nothing in a 5-year holding period. Markets reward patience, discipline, and emotional control. They punish reactivity, fear, and impulsive decision-making. The $100 level is designed to trigger the latter. Understanding how institutional investors approach these moments provides valuable perspective. Their behavior differs fundamentally from retail psychology. Large institutions don't care about round numbers emotionally. They care about them strategically because they know retail investors care about them emotionally. When an asset approaches a major psychological level, institutional trading desks increase their activity, not because the level itself matters, but because retail reaction creates exploitable inefficiency. They're simultaneously watching order books for concentrated buy or sell orders at round numbers. These clusters represent emotional decision points that can be triggered with relatively small pressure. A modest amount of selling can trigger stop losses and panic selling among retail holders. This creates a temporary price cascade that allows institutions to accumulate at artificially suppressed levels. The same dynamic works in reverse. A burst of buying can trigger FOMO buying among retail, creating artificial spikes that institutions sell into profitably. This isn't manipulation in the legal sense. It's simply understanding market microstructure and human psychology. It's recognizing patterns and positioning accordingly. Here's what institutional investors also understand. Time horizon determines outcome. They're not trying to predict what happens next week. They're positioning for what happens over the next cycle. This longer-term thinking makes them immune to the psychological pressure that devastates retail investors. They can tolerate short-term losses because they're measuring success over quarters and years, not days and weeks. When you understand that institutional and retail investors are playing fundamentally different games, the shakeout strategy makes complete sense. Institutions are running a marathon. Retail investors are running sprints. The $100 level is a hurdle that trips the sprinters while the marathon runners maintain pace. Your goal is to think like the marathon runner while positioned among the sprinters. This requires psychological discipline that most investors never develop. The $100 shakeout isn't ultimately about price, it's about psychological resilience. Let's discuss how to build it systematically. First, accept that discomfort is inherent to investing. If you're never uncomfortable, you're probably not taking sufficient risk to generate meaningful returns. Comfort and returns exist in tension. The most comfortable investment is cash, which guarantees loss of purchasing power to inflation. Higher returns require accepting higher discomfort. Second, separate your identity from your portfolio. You are not your investments. A position declining doesn't make you stupid. A position rising doesn't make you genius. When self-worth becomes tied to portfolio value, emotional swings become extreme. This clouds judgment and forces reactive decisions. Third, practice visualization. Mentally rehearse how you'll respond when your portfolio drops 20%, when it rises 50%, when volatility spikes around psychological levels. Athletes visualize performance under pressure. Investors should too. This mental rehearsal makes actual volatility feel familiar rather than shocking. Fourth, build redundancy in your financial life. Emergency funds, diversified income streams, and reasonable lifestyle relative to means create psychological buffer. When investment outcomes don't determine whether you can pay rent or feed your family, you can think clearly. Financial desperation creates emotional investing. Fifth, limit your exposure to market noise. Reduce the frequency of portfolio checks. Mute panic-inducing social media. Consume quality analysis rather than clickbait headlines. Your information diet shapes your emotional state. Consuming panic produces panic. Consuming measured analysis produces measured thinking. Sixth, remember past resilience. Think back to previous moments of high stress. You survived them. The fear felt overwhelming then. It passed. The pattern will repeat. Building resilience isn't about eliminating fear. It's about functioning effectively despite fear. It's about recognizing fear as information rather than instruction. Let's zoom out and examine what the $100 shakeout represents in the context of broader wealth building. Individual price levels don't matter nearly as much as we think they do in the moment. What matters is direction, duration, and discipline. If an asset's fundamental trajectory is positive, if adoption is growing, if competitive positioning is strengthening, then the path from 50 to 200 will include a shakeout at 100. It will also include shakeouts at 75 and 150. Every psychological level will be tested. Every test will create casualties among the emotionally vulnerable. This is how markets separate informed patient capital from fearful, reactive capital. It's not cruel, it's mechanical. It's simply the way price discovery works in systems involving human psychology. The investors who build generational wealth aren't those who perfectly time every entry and exit. They're those who identify correct long-term trends and maintain positions through the inevitable volatility. Warren Buffett didn't become wealthy by trading around psychological levels. He became wealthy by identifying value and holding through decades of market chaos. The same principle applies regardless of asset class. Real estate, equities, fixed income, commodities, alternative assets. Volatility is universal. Patient capital is rewarded universally. Here's the uncomfortable truth. Most investors will be shaken out at 100. They'll sell with relief, convinced they made the smart decision. They'll watch from the sidelines as prices eventually move higher. Then they'll convince themselves they were unlucky, that the market was manipulated, that they couldn't have known. But they could have known. The pattern is documented. The psychology is understood. The outcome is predictable for those who study market history. The question isn't whether shakeouts will occur. They will. The question is whether you'll be prepared to recognize them and respond strategically rather than emotionally. When volatility strikes around the $100 level, maintaining perspective becomes your most valuable asset. Here's how to sustain it. Ask yourself, has the fundamental reason I invested changed? Not the price, not the sentiment. The fundamental thesis. If you invested because of limited supply and growing demand, is supply still limited? Is demand still growing? If yes,